Welcome to episode 2 of our geopolitics playbook. In the next few minutes, I'll show you the simple chain reaction, what to watch, and what it means for normal people regarding Venezuela. Now, Venezuela can feel like a faraway headline, but oil is one of the fastest ways geopolitics hits your cost of living, interest rates, and your portfolio returns. Remember the framework from episode 1. When something changes in the energy supply story, it can push or pull inflation. Inflation influences interest rates, and rates affect stocks and bonds. And then you feel it through prices, borrowing costs, and also currency moves, especially if you are living internationally. So what's actually the Venezuela connection? Venezuela's oil industry is large enough that changes in export rules can affect market expectations. Not always with an instant spike, but enough to change the direction of risk. And here are the key mechanisms. It's sanctions and licenses. The US uses sanctions that restrict who can do business with Venezuela's oil sector, and then grants specific licenses or waivers that allow certain companies and transactions under certain conditions. Like I mentioned in episode 1, Reuters reported that the US was expected to grant an expanded license to Chevron that could allow increased production and exports in Venezuela. And that was based on oil industry sources. Now, to keep this grounded, the US Treasury Office of Foreign Asset Control, or OFAC, maintains the Venezuela sanctions program and the licensing framework. Why does this matter? Because oil prices are driven by global supply expectations. If traders believe more barrels can enter the market, that can ease price pressure. If they believe access gets restricted, messy, or threatened, prices can then firm up. So how does oil affect your cost of living? Well, it hits your life in 3 main ways. First, it will be transport costs. That would be the likes of gasoline or petrol, if you're from the UK like me. Diesel, ride-hailing apps like Uber, Grab, or flights, if you're travelling or you're a frequent traveller. Second would be shippings and logistics. It shows up in the cost of moving goods. That would even apply to like couriering or anything involved under that space. And, as the global supply chain that's heavily dependent on that. And third, and this is the sticky part, when businesses raise prices because inputs rise, those higher prices can linger even if oil cools later. So Venezuela doesn't need to dominate global supply to matter. It just needs to change uncertainty around supply at the margins, because markets move on expectations, not just on today's barrel prices. What it does to markets, well, ultimately, inflation expectations plus rates equals portfolio impact. So now the investor part. When oil prices rise and markets start worrying about inflation, you typically see a combination of bond yields rising because investors demand more return to compensate for inflation. Stock valuations start to feel pressured, especially growth and long-term or long-duration assets. And you'll also see sector rotation. That would be things like, energy companies can benefit, while transport, airlines, and consumer discretionaries can struggle. And here's the subtle point. Even if oil doesn't explode higher, the fear of inflation re-accelerating can change what central banks are willing to do. That can keep rates higher for longer, which will in turn affect mortgages, refinancing, personal loans, and, like I mentioned, bond prices. Let's translate this into plain English. If oil prices rise, inflation stays sticky. That long duration bonds can be more volatile. That means yields up, prices down. Rate sensitive equities can wobble. Energy related equities may hold up better, but they are still cyclical and volatile. Emerging markets, now this can be mixed. Oil exporters and oil importers can behave very differently. So the takeaway isn't just go buy oil or, sell everything. The takeaway is understand your exposure. If your portfolio is heavily rate sensitive, an oil-driven inflation surprise can hit harder than people expect. So what should us normal people do? And this is what I would probably call a calm checklist. First would be don't panic. Budget a buffer. If you're already feeling the cost of living pressure, tighten any leakages before they can tighten you. Maybe cut back in some spending, although it's not nice, some luxuries, whatever that may be. Also, you want to take into account an emergency fund. If your job is in any way, or your income for that matter, is for any way cyclical, consider moving towards the higher end of your cash buffer. Debt. Variable rate exposure matters most in a world where inflation, like I mentioned, can be or remain sticky. So really take that into account, because that's a big one. Any fluctuation in rates, particularly if they go higher, can impact you very negatively. And if you're an expat, watch your salary currency versus your spending currency, because foreign currency moves can amplify inflationary pain. I know I'm certainly feeling that at the moment, with US dollar and Singapore dollar, and also investments in GBP. It's tough to navigate. And if you're investing for the long term, the real edge is simple. Diversify, rebalance, but stick within your rules. If you have a financial advisor, speak to them about it, and don't let the headlines hijack your plans. So that's Venezuela and the chain reaction. Oil supply expectations, inflationary pressure, rate expectations, portfolio volatility, plus real cost of living impacts. Now, in episode 3, I'm going to get even more direct, because I'm going to deep dive into tariff and trade mechanics that can raise prices even when oil isn't moving much. So that's pretty much a wrap. Feel free to comment in the comment section, what country are you in and what's hitting you the hardest right now? Is it fuel? Is it groceries? Is it foreign exchange? You can also feel free to drop us an email at info@expatmoneychat. And, I'd just like to say thank you for taking the time to watch. Very much appreciated. Hit the like, hit the subscribe, hit the share, and thank you for your time. Cheers.